What is the cost of a protective put? Have you ever wondered how investors protect their stock investments from unexpected downturns? One popular method is the protective put strategy. But what does it actually cost? Let's break it down. A protective put involves owning shares of a stock while also purchasing a put option for those shares. The put option gives you the right to sell your shares at a predetermined price, known as the strike price, before a specific date, called the expiration date. The main cost associated with this strategy is the premium you pay for the put option. So, what is this premium? It is the upfront cost of buying the put option. For instance, if you buy a put option with a premium of $2 per share for 100 shares, your total cost would be $200. This is the direct financial cost of implementing a protective put strategy. However, there is more to consider. There is also the opportunity cost. This is the potential profit you might miss out on if you had invested the money spent on the premium elsewhere. If the stock price does not fall and the put option expires worthless, you could feel that loss. Now, let's talk about how a protective put limits your losses. If the stock price drops below the strike price, you can sell your shares at that strike price. However, it is important to note that your effective floor price is the strike price minus the premium you paid. This means that while you have protection, you still need to account for the cost of the premium when calculating your potential losses. Investors often use protective puts as a risk management tool. If you believe in the long-term potential of a stock but want to guard against sudden price drops, this strategy can be very useful. It allows you to keep your shares while having a safety net in place. Another point to consider is the flexibility of this strategy. If the stock performs well, you can choose not to exercise the option. This way, you can benefit from any increase in the stock price. When deciding to use a protective put, it is wise to conduct a cost-benefit analysis. If the premium is too high compared to the risk you are trying to mitigate, it may not be the best choice for you. Lastly, remember that options have expiration dates. This means you will need to regularly purchase new put options to maintain your protection. Over time, this can add to your overall costs. In summary, the cost of a protective put primarily consists of the premium paid for the put option and potential opportunity costs. This strategy serves as a form of insurance for stock investors, allowing them to limit losses while still having the chance to benefit from price increases.